All right, so we got a lot to do this hour, but let's start with about 75% of the American economy, and that is you, the consumer, because the American shopper continues to show they may be getting tapped out. Consumer sentiment at its lowest level in over 2 years. Inflation, it continues to stay warm, which will impact what the Federal Reserve does. And now you can layer on some of the AI hopes, maybe deflating, which could also hit stocks and then maybe hit consumer spending even more. All of that is putting pressure on stocks, with the Dow down as much as 700 points today. So let's talk about all of it with Aditya Bhave, is head of U.S. economics at Bank of America Securities. Sarat Sethi, as we noted on set, managing partner at DCLA and a CNBC contributor. Sarat, let's start with you. Is it tariffs? Is it AI? Is it C, all of the above?
It's all the above, and it's a Friday, and we're going into April 2nd, where people don't know what's going to happen, and really after yesterday when the 25% tariff came on. So really the uncertainty going into a weekend where you've got potential stagflation numbers, you've got potential tariffs coming down the road, you've got an IPO that didn't really do that well, so it's a risk off. It's why put equities or why put money on risk right now. And to your point before, you and I were talking, look, it's not like valuation is really cheap across the market either. So let's look for opportunities. I think you're going to get some in the next 4 to 6 weeks. But in the meantime, the path to least resistance is the market going down.
I don't like the sound of that. I mean, we've had a number of people in recent weeks come on and say there are signs of it bottoming. There's signs, where this and that and the other. Why do you still feel like the path of least resistance is lower?
Because we're going into earnings season in a couple of weeks. And what you're going to hear from a lot of corporations is like, we can't move because we don't know what to do, whether it's, should we do an acquisition? Should we go buy a factory, build a factory? We don't know what that's going to be. So what are we going to do? Nothing. Mm-hmm. And at that point, and you've got a consumer now, and you're starting to see in some of the retail numbers as well. I don't think we're going off a cliff. I'm not trying to say like, hey, this is going to be a 30% correction. It's just that the air is coming out of the balloon, and kind of it's very hard to, if you're going to be trading around these numbers and investing. Look, I think there's some great companies out there that if you haven't bought them in the past, you can start buying them. Okay. But I think we're down 8%, and it feels a lot heavier than that because every day there's some piece of news that can get the market go up 2%, or now we're down 2%. And as people, when you've had 2 years of great returns, right, it just you get price bias, right?
Yeah, Aditya, I want to pick up on something as well that Kyle Bass said last hour when he basically said, yeah, I think the playbook is a recession from the administration, and kind of making an analogy about why that might be good in the long run. But is that kind of, to put differently, what the Treasury Secretary is telling us when he says he wants a lower 10-year? I'm sure he'd want that in a high productivity, disinflationary way. But one way or the other, is that, when we talk about the Trump put isn't there and so forth, is that what you think is going on this year?
So I can't really comment on whether the administration prefers a recession or not. But what I can say is that we don't have a recession in our forecasts. Obviously, you see the weakening in consumer spending. You're going to get a really soft quarter for consumer spending, right? But some of it might be idiosyncratic. So there's two things going on. The first one is stagflation. That's your word of the day. Nominal consumer spending actually looked fine. It's just that for the last 2 months, a lot of that has been eaten away by inflation, right? And then on the second thing, what I would say is goods spending was okay. Services were really weak. Within services, food services were soft. So if you want to look for a silver lining here, maybe some of that is weather related. If you look at kind of real-time indicators for March, I think things actually look okay. You see that in our card data, the data that cover folks that have BAC cards. You see that in the tax refund data. You see that in air travel. So I don't think we're setting up for a disaster. I don't think we're setting up for a recession. But are we in a soft patch? Yes, we are. And the reason is stagflation.
Aditya, let me approach everything from kind of a different way. Should there be any surprise from anyone if the consumer slows down? I wouldn't be surprised. $1.2 trillion in credit card debt. Home prices are still up, even as monthly payments are up. The average car price is almost $60,000. I'm confused maybe more why anybody would think consumer spending would remain strong.
I'm going to push back a little bit on that. I'm actually pretty optimistic about the consumer. Why? Because what we've learned over the last couple of years is that real income growth is the #1 driver of consumer spending. And for all of the inflation that we've had, cumulatively, wage growth has outpaced price growth. And if anything, that's happened more at the lower end of the spectrum. We've also added a good number of jobs over the last 5 years. So in that sense, income growth has kept up and actually outpaced the issues that we've seen with prices in aggregate. So that's helpful. And then on the balance sheet, while there are concerns about credit card debt, that number is quite small compared to the biggest driver of consumer liabilities, which is mortgages. And folks are not defaulting on their mortgages because they're locked into low fixed rates. If you look at overall ratios of assets to liabilities, you look at delinquency rates across all types of debt, all of those indicators look quite benign, quite encouraging. And even in the last couple of months, despite the weak spending data, you've actually had strong income growth. So the saving rate has gone up. So I'm not worried about the consumer until the labor market cracks.